So welcome aboard, and I'll just share my screen and we'll get into it. All right, so the first thing I want to address is just a common question or common misconception out there is about how our tax system works in terms of for individuals compared to a lot of businesses such as companies. The companies is quite a simple methodology. It's the flat rate of tax, currently 27.5% for small business and dropping down to 26. I'll just admit Dean to the meeting. So yeah, so hi Dean. So yeah, just wanted to talk initially about individual tax rates. So it's a progressive system, not a flat rate system for individuals. That's an important element when people ask me how much tax will I pay, and the first response is depends on what your marginal tax rate. When I leave my margin, I'll show that in a minute. Also in Australia, we have what they call a tax-free threshold. So up to $18,200 is tax-free income for people. So some employees, when they start their work, there's a little box you tick on the form to say, do you want to claim the tax-free threshold? So you normally claim that from one of your employers. It's a little bit more complicated now. People have multiple part-time or casual jobs, but that's essentially the way the system was structured. Also in Australia, we have a Medicare levy system, which is predominantly means of it's a tax really, but they call it a levy. It goes into sort of Commonwealth government, and then they distribute that into the health system. I've also got a private health system. So you still pay Medicare levy even if you've got private health. That's another misconception. It does stop you paying what they call a Medicare levy surcharge once your income goes above a certain level. Another comment I just want to make about our tax system for individuals in Australia was just about rebates versus deductions. So the sort of colloquial throwaway line from, you know, not picking on them, but Harvey Norman and people like that, they go, well, this claim it on your tax. So claim it on your tax means it's effectively a tax deduction. So you get the deduction of the tax that you would have paid on if you hadn't claimed that deduction. So you don't get 100% of that cash back. That's the important point I want to make. You'll get the tax that you would have paid at your marginal tax rate back on that. So if you spent $300 on a computer or something like that, or on a printer, then you'll get, and you're paying tax at 19%, you'll get 19% of that $300 back. You won't get the $300 back. Whereas a rebate that the government introduced from time to time gives you the full credit on the tax. So I just wanted to make that sort of point there. And just to back that up, is just that's a sort of quite a busy slide, but just to re-emphasise, for Australian residents, the tax rates for the 1920 year. So that's what the first 18,200 is no tax payable. 18,201 to 37,000 is 19 cents in every dollar over 18,200, and then it keeps sliding up. So when you say what's your marginal tax rate, so if you're earning say $60,000 of taxable income, you're paying you're in the bracket of 37,001 to 90,000. So you're paying 32.5% for every dollar you earn additional in that tax bracket. You still get the first 18,000 of income tax free. You still get the next 19,000 to 37,000 at 19%. So you still get the benefit of the lower levels. But for every dollar you earn, you what you call a marginal tax rate. We also have compulsory super of 9.5%. So if you're employed by someone, you're paying superannuation on your gross wage of 9.5%. And we have a Medicare levy, which is 2%. There is some adjustments for lower income earners, but essentially once you're above about 23,000, I think from memory, you're paying 2% Medicare levy. You never see that per se. If you're salary and wage, that just comes out of your part of your total tax that your employer would withhold from you. So just a recap, I suppose, or just an overview of so most individual tax returns are talking about salary and wage earners. and you have salary and wage income. So you're employed by someone, and you get your fortnightly paycheck from them. So those of you who've been around for a little while would have been used to the term group certificates. So you used to get a paper group certificate by your employer at the end of the financial year, and it would summarise what your income you've earned throughout that financial year, and it'll classify some of your income into, say, normal income, allowances, and how much tax has been withheld. That then moved into payment summaries probably 5 or 6 years ago, a bit more of an electronic format. I think it was a year ago they changed the term to an income statement. And so this year is the first year where we've got pretty much a full electronic system with the introduction of single touch payroll, or STP, for every employer that came into effect 1st of July 19 for every employer apart from micro and family-based businesses. And so what that means is that instead of getting a paper copy or even an email from your employer, essentially all that information, once your employer hits the button, and they've got to the 14th of July, so that was yesterday for most employers, and they lock those figures away, and then it gets updated electronically into 2 areas, one area mainly, via MyGov ID. That's really the tool that most individuals now will be able to see what their income has been and how much tax is withheld. In conjunction with single touch payroll, the employers now have to provide electronic means what the year-to-date earnings and tax is for each individual employee. So you'll have, under MyGov ID, you'll have your earnings, what was the last financial year, but then those who have used it, you'll be able to log in at any time throughout the year and see how much your year-to-date earnings are. And whilst I'm sort of in that MyGov ID, another thing to look at is your superannuation. I understand that there's some super balances you look up on your MyGov ID. So it's a good idea to do that for 2 reasons. One is if you've got multiple accounts, sometimes people just change jobs and forget that they had an account set up somewhere else. And secondly, as a sort of a double check to make sure your employer is doing the right thing. Most employers do, but just double check that they're actually paying your superannuation. You get a pay slip that says how much super is being paid, but your MyGov ID is a double check to make sure that actually super has been paid. I've got there next to MyGov ID is a thing called pre-fill. That's another term that's been doing the rounds in sort of my world and coming out to the public arena now. So pre-fill just means it's electronic ways of the information is being updated. So as I mentioned, this year, your annual payment summary is pretty much done electronically through MyGov ID and pre-fill. Use a tax agent such as myself. Then from, I think yesterday, they resolved a few gremlins and we're starting to get all that information electronically as well. I think there's a lot of private health. You would have got a paper confirmation previously to take to your accountant or to use to lodge your tax return of what your private health rebates might look like. Most of that, all of that's going into a pre-fill into MyGov ID or to the tax agent as well. So that's where the world's heading, is it's more with electronic updating of information. Just a note on JobKeeper income. So that's a sort of an often asked question. So if you are in receipt of JobKeeper income as an employee, that is still taxable income, and that will come through on your summary for earnings for the year. Typically, if the employer's done it correctly, it should come through as an allowance if you were getting topped up. If not, it'll just come through as your gross earnings if you had no change to your pay and your employer was effectively using it as a wage supplement. So that's free for the employee. So I'm not talking about Job Seeker, which comes through the Centrelink system. This is the JobKeeper that was done through your employer. A little bit more complicated if you were a business owner, but this is purely looking at if you're an employee. So something to watch out for there. Deductions. So just an overview of your motor vehicle deductions. So your rule of thumb, if your car is used or is used for work purposes, then you can claim deduction for your vehicle. Bearing in mind that home to work travel is not claimable. So we're talking about if you had, part of your job is to duck out during the day and get the mail, go and get the fruit and veg for your restaurant, something like that, then you can claim that travel time. If you do get reimbursed by your employer, likewise, that would be income for you. If you don't get reimbursed, it's just supplementary, then you can still claim the deduction for it both ways. So in the 1920 year, 68 cents per kilometre as a flat rate, you're allowed to claim up to 5,000 kilometres for that vehicle for the year. 9 times out of 10, this is the best method for a salary and wage earner, I find. Methodology to keep that, some form of record, could be a logbook, or could be a reasonable estimate. If you have a regular gig on a Tuesday that you go and do something for work, then you can say, I did it 40 times a year, it was a 20k round trip, that sort of estimates. There are other deduction methods available that may give you a higher deduction, but a little bit more complicated in terms of record keeping. And so typically I only sort of see those methodologies being used if you are like a travelling salesperson or something like that you're using your car, 70 or 80, 90% of the car for work purposes, in which case you'll keep a logbook for 12 weeks and claim a percentage of your total running costs. So just going back to the flat rate of cents per kilometre, that's an all-inclusive rate, so it does include your operating, your running costs such as fuel, services and rego, but also includes a portion of that 68 cents is for what you might call depreciation or wear and tear on your vehicle. So that's an all-up rate there. So working from home or home office is sort of topical with most or a lot of people working from home during the COVID period. So the ATO have announced a flat rate just to keep things simple for people. So it's a flat rate of 80 cents per hour for every hour you're working from home. And that was in place from 1st of March 2020, which they've said was sort of the start of the COVID period in general terms. That's a nice simple method. If you're doing your own tax return, you can do it that way. And it's an all-up rate, similar to the cents per kilometre for vehicles. It's 80 cents an hour. There are alternative methods, and often I find the alternative method will probably give you a higher tax deduction, but the trade-off for that is you just got to keep better records. So there's 52 cents an hour you can claim for your power and other sort of home costs if you want, just the cost of wear and tear on your carpet and insurances and what have you. But then outside of that, there are other costs that you could claim on an actual usage basis, such as the home internet. So if you pretty much lived on your internet during COVID, working from home, and you're on an $80 a month plan or something like that, then you might say, you come up with the best estimate of how much of that time or that use was spent for business or work purposes. So typically, that on top of your 52 cents an hour, claim for your stationery, your incidentals, your printer cartridges, your paper or whatever else you might need in your desk at home or something, then typically that bundle will probably exceed the 80 cents per hour. But so you do have those two options to consider when you're doing your tax return. Quick run through is quite a bit on this page. So other tax deductions, you've got if you're a tradie or something similar, you've got tools. Less than $300 you can write off immediately. More than $300 you do what they call depreciation, so you write that off over a period of a number of years depending on what the useful life looks like for that. Deductions for clothing, that's if it's a uniform typically, or work boots that are steel cap boots for someone, and then the laundry relating to that uniform or protective clothing. So laundry, if like someone like myself, I can't claim laundry because I don't wear a uniform to work and I don't really need protective clothing. But if I'm working in a cafe and I've got aprons and trousers and a white shirt, that's not necessarily uniform, but it's occupation, what they call occupational specific clothing, then normally you can claim the laundry expense. And the tax office have got some overly complicated rates to work that out. Rule of thumb, up to $150 you can claim in that space on a reasonable basis. Any union fees you pay are tax deductible. Any self-education above $250 is deductible. It's got to be related to the income you're earning at that time. So someone like myself, I can't all of a sudden say I want to be, say, a psychologist and go and claim for myself education because I want to become a psychologist. It would have to be something to do with my current income or advancement. So they're saying, you know, if I do another certificate and gives me advancement in my current earning capacity, then that's your self-education. You can't claim the HEX debt that most people put on their tab, or if you prepay as you go, that's not deductible. Mobile phone is an interesting one. It's sort of changed in the last year or two, that it's almost like a tool of trade for a lot of employees. Like my staff here, with things such as two-factor authentication, a lot of software packages we use now, then your mobile phone is sort of, you know, it's very much an essential element. And I've noticed here, people working from home, then people, you know, there's a blurring of the lines. People's personal mobile phones are now sort of become a business tool for a lot of employees. So I find that if you come up with a reasonable estimate, then you can pretty much justify quite a high percentage that's required for business use. Most people are on a flat plan, so it's, you know, $60 a month plan, something like that. You might say half of it is claimable under sort of for work purposes. And I know for my son, like, he's on call a lot for casual jobs. It's once again, it's another argument to say it's an essential tool of trade. Donations, so that's deductible gift recipient donations, DGRs, get the receipt $2 and over from Red Cross and people like that. So that's all tax deductible. In terms of insurance, your income protection insurance if it's outside of super. So if it's inside super, then it's a deduction within your super fund, not yourself personally. But some people have decided, and rightly so, to have that policy outside of super and pay for that out of their after-tax dollars. So that's deductible as well. Any super contributions, so you can claim up to $25,000 as what they call a concession or tax deductible contribution. That's a total of all those contributions. So bearing in mind, as I've mentioned before, your employer will pay you 9.5%. Then if they've already paid 10 grand, you've only got 15,000 less to that cap to get the full tax deduction. And then a little plug that if you do go see a tax agent, then that fee is tax deductible as well. Investment property. So just in overview terms, it's your net income or net profit, if you want. So your rental income, so whatever you get per week on your investment property is taxable, less these range of deductions. So if you've got a property manager looking after it, all of their fees are tax deductible. So often it's a percentage of their rent. They might charge an admin fee, property inspection fee, or releasing fee. All of that bundle is tax deductible, including the GST that you pay, because 99% of people are not registered GST, so you pay the GST and claim that as well. Interest on loans, so you just got to be careful the way you structure the loan, that it's relating to that particular investment property. Also be careful that you don't have a redraw facility that you're then able to draw down and then top back up. Tax office have got I was going to say quaint, it's worse than quaint, it's a sort of a ruling that means that when you take it out, say you took 20,000 out of redraw for a period of time, put it back in, you can't recalibrate that balance back and claim the interest on the original balance. So to get around that issue, I normally recommend people go, if they can, with their bank, get an offset account, which means that any credit balance they keep in the offset, the bank charges the annuity difference. So you got $200,000 loan, $20,000 say sitting in your offset account, they'll charge the interest on the difference, being $180,000 net debt you have to the bank. So you get the benefit of the interest relief, but yeah, redraw investment properties can have negative effects if you are using it as a bit of a tool on a redraw arrangement. The other point to make, it's not your loan repayments, it's only the interest component of on your loan that you've taken out. There might be some upfront fees as well to establish the loan. Once again, they're not deductible at the time, but they add what they call to the cost base. So if you ever sell the property down the track, then you can use that as a cost of establishing and buying the property to work out any capital gains. So any rates, land tax. So land tax, normally if this is your primary residence, you don't pay land tax, but as soon as you rent it out, normally depending on which state you're in, you get slagged by the state government a land tax bill. Your rates is normally from your local government, and then your water rates as well. Typically, you normally see the supply charge for, say, a Tas water bill, where that will get paid by the landlord, effectively, which is the taxpayer in this example, and then the usage might be on charge to the tenant. So that on charge that the tenant might pay is still income for yourself as taxable income, but then you've got the deduction for the usage as well on the other side of it, so it's a net zero tax position. R&M, repairs and maintenance, a couple of little tricks in that area. The technical ruling from the tax office is on two fronts. One is got to be a replacement, not an improvement. So they give examples in their rulings, such as you replace a timber fence with a steel fence, then is it like for like? Is it an improvement on the whole area rather than just replacing timber for timber? So you can get caught if you don't follow those rules exactly. The other one is, and it always frustrates me, but that's just the way the tax office have ruled in this space, is if the property is not rented at that point in time or not available for rent, then you can't claim that repair at that point in time, but you can claim that capitalise that and claim the depreciation over a period of time. So you see it quite often, the tenant will move out and give it a lick of paint before you put the new tenants in. So a way to sort of combat that is to say, well, it's available for rent, you can take people through to show it, and give you a couple of weeks while you paint the place before you rent it out again. There's a couple of little things to watch there. Any other outgoings to the property, so you might have insurance, if it's a unit, you might body corporate, and any cleaning costs that you need to do pre and post. Some people bundle up into their rent, a gardening arrangement. So all that is all fine as well. Just want to speak on depreciation. So that's actually, for a lot of properties probably built after 1985, can be a really great source of it getting additional tax deduction. There's organisations that what they call quantity surveyors that will do the depreciation tax report. So it's something I can't do as an accountant, but so these guys are more in the building game. But because it's such an attractive option for people, there's quite a few players in the marketplace. One that springs to mind is BMT. They do it nationally. They do a flat price, and a lot of these providers as well will offer a guarantee that whatever their fee is, they'll give you effectively the tax deduction or more as part of that. So it's certainly worth exploring that and shop around as well what options you might have in that space. Typically, probably $600 or $700 to get that report done. That's tax deductible, and then they'll give you an idea whether that's that type of property is going to be worthwhile getting the report done. They changed the rules back in 2017 a bit. It used to be that you could claim, so if someone did a kitchen up, say 3 years ago, and you bought the property, you could claim the residual tax benefit for that depreciation. They've stopped that now. You can only claim the depreciation on any works that you do. But there's also a capital deduction available for the actual building itself, and that's a 40-year write-off, and you can pick up the remainder of that 40 years. If it's a 15-year-old building and it's 25 years worth of deductions, you can still claim over time. At the same time, that they also stopped any travel claims after 1 July 17 to be able to be claimed against. So that sort of put paid to a few people having a trip to Queensland and look at their rental property. and claiming it on their tax. So that's sort of closed that as an option for people. And I'm talking about individuals here. If you've got investment properties in other structures, there are some relief for that. But yeah, for individuals, it's those days are over. So yeah, I'll just throw it over to questions. And if you've got any questions, Dean or Georgina?
Sorry, I'll let Georgina go first. If she...
You're the
man. With private health insurance and the Medicare, there's a Medicare surcharge if you don't carry it, isn't there?
Yeah, I think it's 180k combined income. I think it kicks in, and that's I think from memory that's adjusted, not just taxable income. I think it's adjusted income. So some people can get caught if they're doing salary sacrifice for employers. So Centrelink and the tax office have got a little what they call add backs. So it might be taxable income of $70,000, but you've got $20,000 effectively that you're salary sacrificing through if you're working for a hospital, not-for-profit or government. Yeah, so I think it's combined adjusted income around 180 that you'll pay the surcharge. And I think it's another 2% on top of it if you don't have private health.
So, oh yeah, okay, because the Medicare charge itself is 2%?
2%, yeah.
And what the Medicare surcharge is another 2% on top of that, or one?
1.5 or something like that. It's a bit of a slug. Yeah.
Yeah, makes it worthwhile getting private health insurance.
Yeah, it does. Yeah, once you get to that level. Bear in mind, so I rightly or wrongly dropped mine about 10 years ago, and then our combined incomes sort of around that figure now, and took it back up, but they slug you a penalty because you've been out of the system for a while.
Yeah, that's what we've faced as well. So.
Yeah.
No, I don't think we touched on rental properties and depreciation. So, for example, we replaced an air conditioning unit in a rental property, and I just depreciated that over 5 years. Is that an acceptable method?
I think so. That's a fair method.
Yep. Cool. All right. Yeah. No, I had no other questions. I got a phone call from my son this morning saying he thought he was getting $2,200 back on his tax return, only got $1,000, but he forgot to take into account he was getting some of the job seeker allowance while he wasn't.
Oh yes. Yep.
Yeah, whilst he was sort of displaced from his work.
Yep.
So that gets taxed, doesn't it? It gets combined in.
Yeah, that's a taxable income.
Cool. All right. No, thanks, Michael. That was great.
Nice, Dan. Anything from you, Georgina?
Yeah, I was going to ask about the working from home things. I think it's a bit confusing for a lot of people.
Yeah.
Because you mentioned like things like power, but also like your wear and tear on your carpet, or I don't know, other home costs.
Yeah.
How like diligent do we have to be in keeping record of that, or is there a threshold where you don't have to have records for all of that claim, if that makes sense?
Yeah, they haven't given it a threshold. They've the 80 cents an hour is sort of a concession where you just come up with a bit like the cents per kilometre. It's an all-up rate. It's nice and simple, and you have to have reasonable estimates. So you just have your timesheet to say, oh, yeah, I was working 10 hours a week, 38 hours a week, whatever it might be, and it was 10 weeks or something like that. So you just apply one to the other. So that's sort of a reasonableness basis. Whereas the alternate method I was proposing that might give you a higher deduction, you have to be a bit more granular, where it might be down to, so 52 cents an hour is an all-up rate. So you could apply the similar methodology in terms of how many hours you're doing that. But the tax office in the detail would potentially be more pedantic about having the proper records if you go away from the 80 cents per hour. Does that make sense?
Yeah, that does. Also, say if you live with other people, like either your partner or your housemates, how would you just recommend Like you obviously can't claim the whole power bill if your other people are claiming part of it.
Yeah.
How would you kind of work that out?
So if you're using 52 cents an hour, then it's just a matter of the number of hours that we're using the power for the computer and the lights and stuff.
Yeah.
Or you could do what you're suggesting is that you can take the percentage of actual costs. That in a shared house, that's just going to be so hard to do, I reckon. And you read the tax ruling and that it just does your head in, because it says, how many computers, how many lights are on at the time, just ridiculous stuff. But that's just the way they've written it, because they don't, they want to make it that, I suppose our option is a bit harder for people.
So if, for example, if I'm the person that pays the power bill, can I claim all of that for myself, and then my other housemates can still claim the 80 cents per hour? Or how does that work? Like, would they
the 80 cents per hour is still, you need to have a cost that you've incurred.
Yeah.
So if you had rent and you didn't pay any power, then, but assuming that you pay your fair share of power, then they're sort of saying, all things being equal, we'll allow swings and roundabouts the 80 cents per hour.
Yeah.
But for everyone, so, in theory, that house could be getting $2.40 to $3 if you're living in the house.
Yeah. So in that scenario, it's probably better that you just claim the 80 cents.
Yeah,
right?
Yeah, that's probably simpler. Especially like home internet, then you go, well, you might have the house has the internet and you pay a third each. So you can still work it out, but shared houses would be harder to work out compared to the 80 cents an hour, X weeks by average number of hours per week you work from home. Yeah.
I was just going to say, I looked at it yesterday, and if there's two of you living in the house, you can both claim the 80 cents an hour each. So, yeah, in simple terms, if you say 80 cents an hour times 38 hours a week times, say, 12 weeks or however long you've been working from home, for us, that worked out to a claim of close to $400 each, which is not bad when you consider, as a share of your power bill or a share of your internet cost or whatever. Simplicity is good.
I think, that's a good point, Dean, because initially when I did some individual back of the envelope calcs, I think people are going to shortchange themselves, but when it's both of you are getting 80 cents an hour, if you're both working from home, then you're right, you're both sort of getting the benefit. Whereas under my sort of proposal, the actual alternate method was like, well, you grab your home internet bill and then you work out it's 80% business use, then you divide it by 2 because you only claim half each, then you're probably diluting that claim compared to